I mean, I'm just going off what, technically they suggest 20% off of the low is a bull market. We've been having debates almost every day on this network as to whether it is really a bull market
you're telling me,
or not.
So you're telling me Pac West stock is in a bull market?
Your point is well made. So in this environment, then, you obviously don't like risk assets. If you think that the stock market is in, at least part of it is in what you're describing to be, I don't want to use, you didn't use the word bubble, but it sounds like you're describing something like that in a certain part of the market. What do you like here and now?
Again, I haven't really changed my game plan for about a year and a half, maybe even coming on a year and 3/4. And that is systematic upgrading in fixed income portfolios. This is the perfect time to do that because we've had, with the stock market going up, a pretty nice rebound and a bid that was completely absent a few months ago, even in triple C assets, which are doing well in the junk bond market. But I think this is the time you want to have a barbelled portfolio with some risk assets, primarily in bonds. In the past, we spoke, Scott, of a 30-60-10 type of portfolio, stocks 30, bonds 60, and then something like gold, maybe 10%. That's just a proxy for some sort of real asset. Take your pick, your real asset of choice. But now I think you should be 20% stocks, 60% bonds, and 20% in that real asset. The fixed income market is very cheap compared to the stock market. I've talked about this. You can get 5% in a very high-grade bond portfolio with no default risk. You can get 8, 9, 10% in a well-positioned, actively managed fixed income portfolio that is taking middle part of the capital structure. At this juncture, triple C, I don't like at all. Even single B, I think is starting to be something you might want to upgrade in away from higher up. You can get all these yields, and you have all this upside. What people don't understand is thanks to the fact that rates went up a lot, and the fact that spreads on risk assets and bonds are somewhat elevated. They're down from where they were, but they're at about 450 basis points. I mean, you're talking about prices that have went from 100 on these credit bonds down to 80, 70, 60, 50 because of those rate increases and some of the fears. When you buy risky credit or moderately risky credit in fixed income at a price of 100, you've got a really bad proposition because they can't go up very much. If the prices go up, they'll just refinance them because the prices going up means that they can do new issue bonds at lower yields. And so they'll refinance them and they'll take your coupon away. But and you have all that downside. If start out at 100, you can go to 80, 70, 60, 50, which is what happened. But if you start out with a portfolio of bonds at 60 or 65 cents on the dollar, you've got 50% upside to par. You have stock market-like upside, maybe even, I would argue, even greater upside than the stock market from these valuations. And the downside can't be any worse. Stocks can easily drop 50%. We've seen it so many times in my career. And the bonds aren't going down to 32.5 unless there's a massive default problem. If there's a massive default problem, stocks are going down more than 50% because they're junior in the capital structure. So fixed income right now, it has 4 times the payout of the stock market if you do this kind of barbell I'm talking about, and you can hedge it with treasuries because long bonds are not at 1% or 2%. 10-year treasury is up near 4%, and it could very easily fall to 2% in the wrong type of economic environment for stocks or risky assets. That's a 20% gain plus coupon. The long bond could give you a 40% gain plus coupon. That can offset your risk. This is an exciting time for the fixed income risk parity, if you want to call it that trade, because we're back where we were in 2012 or so, where you can get yields and you can risk manage very, very precisely.